A Secure Act 2.0 signed into law on December 29th, 2022. This is nuts, right? Signed into law December 29. Some of the provisions become effective like 2 days later, including the new RMD ages. The reduction in excise tax also took effect in 2023, but that's a good thing. So we like that part. And we like the increase in RMD ages, but we didn't like the fact that it was signed into law so late that plan administrators and IRA custodians and many of us are trying to scramble to get things in place. For instance, a plan administrator might have RMDs set on autopilot. How could they have stopped those RMDs from going out? Let's talk about what I'm talking about. The new RMD ages. Before Secure Act 2.0, if someone asked me, what is the age at which someone must start taking RMDs? I would say for the year they reach age 72. But now if you ask me that question, I'll say, hang on a second. What is their date of birth? Because that's going to drive the answer, right? If they were born June 30, 1949 and earlier, their first RMD year is age 70 and a half. Now we call it applicable RMD age, which is the first year for which an RMD is due. If they were born July 1st, 1949 to December 31st, 1950, then their first RMD year is the year they reach age 72. If they were born January 1st, 1951 to December 31st, 1959, the first RMD year, their applicable RMD age, is the year they reach age 73. If they were born 1959 and after, it's age 75. And I know right now you're looking at the screen and you're saying, Denise, do you have a typo? Because I see 1959 both in the age 73 category and the age 75 category. What gives? Well, that's exactly the language that's in Secure Act 2.0. And it appears that they made a technical error. The rumors I'm hearing is that corrections for these technical errors should be forthcoming very soon. So fingers crossed. But the good news is, for someone who was born in 1959, we have quite a few years before we get to those individuals. And if you're like me, you're probably looking at the screen right now and scribbling, taking notes. Don't worry about that. As you can see on the side, I'm giving you a copy of my RMD quick reference guide that includes this table. Now, we got to remember the required beginning date as well. That's April 1 of the year that followed the year in which the individual reaches their applicable RMD age. The RMD is important, especially for beneficiaries. It determines when the IRA owner must start taking their RMDs, the drop dead date by which you got to take your first RMD. But it also answers the question, for someone who inherits an retirement account, did the owner die before the required beginning date or not? So now we got to go back. Let me go back and look at that table. We got to look at that table, figure out what age the IRA owner died or plan participant, and then determine if they died before April 1 of the year that follows the year in which they reach that applicable RMD age. Now, for an employer-sponsored retirement plan like a 401k, the terms of the plan could provide that the RMD is deferred. The required beginning date, the first RMD year is deferred past those ages until retirement. But never assume that that is true. Check with the plan administrator to be sure. And remember that this option to defer RMDs past that age is not available to a 5% owner. So you have your clients who have a solo 401k or whatever brand name is used, they're not eligible for that deferral. So out of this new RMD age came the dilemma. someone who reached age 72 in 2023, they don't have an RMD, right? Any distribution that they take is a regular distribution. But the plan administrators who didn't get time to change their system to accommodate that change were sending out RMDs to these people. And IRA custodians were sending out RMD notices to these people saying, hey, you got to take an RMD. And a lot of these people are like me. You get a notice that you need to do something and you do it. When I get a bill, I pay the bill. I don't wait until the drop dead date that you have to pay because I just want to pay it and move on. And a lot of these people are like that. So they get that notice and they take the RMD. So what they should have done was to throw that notice in the garbage, but they didn't know, right? And so they took those RMDs. The IRA custodians who sent out the RMD notices were supposed to send a follow-up notice to those affected IRA owners saying, listen, you don't have to take this RMD, but a lot of them didn't, right? Or based on conversations that I've had with advisors, individuals either didn't read the mail that came in because I suspect that IRA custodians did send it, but somehow it wasn't seen by the affected IRA owners. So Notice 2023-54 provides transition relief and says any one of these distributions that were made from January 1st, 2023 to July 31st, 2023, that they thought was an RMD, but it's really not an RMD, they can roll it over by September 30th, 2023. Usually there's a 60-day deadline for completing a rollover, right? But here they get an extension to roll it over. My recommendation is do a report, find who these clients are, and call them up or send them an email and say, listen, you can get that money back in if you want to. Let's take a look at an example where John was born in 1951, so he reached age 72 in 2023. And he received a distribution of $20,000, and it was treated as not eligible for rollover because it was mischaracterized as an RMD. John has until September 30th, 2023 to roll over that mischaracterized distribution. And of course, with IRAs, we have a problem because when you take a distribution from an IRA and roll it over back to an IRA, that's considered an IRA to IRA rollover, and that can be done only once during a 12-month period. So what do we do now? Can we have these IRA owners roll over that RMD if they had already done an IRA to IRA rollover during the preceding 12 months? Yes, they can. Notice 2023-54 includes a waiver when you look back and ask, did that person already perform an IRA to IRA rollover? But that's where it ends. If they roll over this RMD now, looking forward, they cannot do another IRA to IRA rollover for the following 12 months. And that's where we come in. What if your client comes to see you and say, listen, I missed a 60-day deadline, it's after September 30th, then you're going to look at other options, including the self-certification solution on the Notice 2020-54. I'll include a copy in your handout. And in that notice, the 2020-46, my memory just came back, 2020-46. And what the IRS said is, if the 60-day deadline was missed due to certain reasons, then the IRA owner or plan participant can self-certify that they qualify for a waiver of the 60-day deadline. And the rollover generally must be completed within 30 days after the reason for them missing the deadline no longer applies. And it includes a sample letter that can be attached to the rollover. So I'll include that in your handout. Now, what if the 1 per year rollover rule is an issue? The 1 per year rollover rule applies only if you're going from IRA to IRA, right? It doesn't apply if you're going from IRA to employer plan. So if the client is a participant in an employer plan, and if the plan accepts rollovers from IRAs, then it can be rolled over to an IRA. But what if they're not lucky enough to have that option available? Then they can put it in a Roth IRA. That will be a Roth conversion. And yes, right now you're saying, but Denise, they don't want a Roth conversion. That's going to be taxable. Well, it's better than having them hold on to it and include it in income where earnings are going to be taxable, as opposed to moving it to the Roth. Yes, it's going to be included in income there too, but the earnings are tax deferred and become tax-free once the individual is eligible for a qualified distribution.